What's going on, everyone? Welcome to this week's live backtesting. Today's topic is equilibrium versus discount. Still within month one of ICT's concepts as core mentorship. Still, and it's lesson 3, if I'm not mistaken. No trades for me this week. Still not actively trading, just based on where I am in the mentorship. But I think by next week, maybe late or the week after, I should start getting into the market and finally getting back into some positions. So just going over this session's focus. There will obviously be equilibrium versus discount. These are long positions that we're looking for. And maybe just, yeah. And it's essentially, the question that he asked was, if a trader has a strong conviction that the market will go higher, how does he or she confirm this? And so what this is really from a high time frame context, framing areas where the market has a high probability of trading higher from. And so identifying buying conditions in the market, essentially. And not, I didn't say conditions where the market will go higher, because nothing is certain. Trading is a probabilistic game. It's a game of probabilities. So we just try to identify in what conditions something is likely to occur, and over time try increase the likelihood of our strategy playing out, increase the probability of that strike rate, increase the probability of profitable trades, or and increase the strike rate rather. And so what are we looking for? He framed it mainly from a daily perspective, but obviously price is fractal, and so all the concepts are essentially applicable on all time frames. But this is more to get an idea from a high time frame perspective of where we should be looking for buys. I understand some people do use this as an entry, but obviously coupled with other techniques. But we essentially look for a clear impulse higher that shows displacement. The market then forms a swing high, which is characterized by 4 candlesticks. We'll see from those 4 which candle printed the clear high, and then the 4th candle needs to close lower than the candle that forms the high. So this then is our first indication that the market is forming a retracement or starting to pull back. The market then pulls back to equilibrium, which is identified at the 50% level using the fib tool. This is also known as fair market value. And then price then rallies above old institutional order flow, which is essentially old highs or clean highs. And we'll take a look at that in a second. And then last note, market will not sustain discounted levels for a long period of time when the market is bullish. And so we expect to see, or we anticipate a quick reaction from these levels. And look, a quick reaction could be 3 or 4 candlesticks. In days, that's 3-4 days. In a 4-hour candle, that's half a day, potentially just over half a day. And then within a discounted area, the midpoint of the 62% to 79% Fibonacci level is an optimal trade entry area. And so the 62 to 79% level is essentially what we call now our discounted level. Anything technically below equilibrium price is now in a discounted area. But he's identified that 62 to 79% range. I think it's actually 61.8 to 78.6, if I'm not mistaken. But the midpoint of that is that optimal trade entry area, which is, I think, about 70.5%. And you want price to trade obviously below the equilibrium into this optimal trade area. And then looking at where price then trades to, TP should be aligned with old highs. This doesn't have to be the oldest high. The most recent high as part of the current structural leg, or legs are suitable. And again, I'll add context to that in a minute. And then some house rules for today, or maybe let's just switch this up a bit because we're still on session focus. In the session, what I'll also be mindful of is previous concepts that I've back tested, because we're trying to stack concepts on top of each other now, not look at them in isolation, but obviously following the sequence that ICT is teaching it in, so that I guess we digest the strategy in a coherent way. And so the interbank price delivery model is what I'll be keeping an eye out for. As you guys remember, that's consolidation followed by expansion and then retracement or reversal. Well, retracement and then continuation, or expansion and then reversal. And so I'll be keeping an eye on that, just in terms of how does that line up with what we're looking for today, as well as then old highs and lows that haven't been retested in a while, how price reacts to clean highs and lows that are formed, and then areas where price has moved quickly, where prices move quickly from. So, and this could be an order block, fair value gap, some other concept, which technically we haven't learned yet. But obviously, these concepts, you remember in the last backtesting session, we were just marking those out on the chart, and so this concept of identifying uh, buying conditions in this discounted area, I think it's going to give some context to the things we were identifying last time, just to see, how it all stacks on top of each other. And then house rules for today. Focus of this session, guys, is going to be more backtesting, less talking. I'm trying to get a lot of value out of these sessions, and I think in past sessions, I found I do a lot of talking while I'm backtesting, which isn't normal. And while it is valuable, I think it takes away from the amount of data that one can get through in these sessions. And so I'll work 1 week at a time, because I'll be doing quarter two, April 1 to June 30th on USDZAR 4-hour time frame. But we'll work in 1 week sort of intervals where I'll identify impulses, corrections, continuations as per the above criteria, and then I'll discuss my observations after each week. And after each sort of trade opportunity that I identify and then subsequently screenshot and bring into here, I'll just delete that on the chart. But don't worry, because I'll have the screenshot and then we can just chat about it at the end of that week, just so I can give context to what I was essentially seeing in that moment. And then, I'll be looking for areas in price where the concept plays out as well as where it doesn't play out. So either obviously we get the impulse and then we're looking for the pullback into that optimal trade entry area, or equilibrium. So either price just violates all of those levels and does 100% or more pullback, or it does respect that discounted area, but then doesn't achieve the TP that we essentially set out. So our old institutional order flow. Just because the purpose of the session isn't to just regurgitate what I'm learning and just try find where it's playing out. It's to determine the probability of price reacting to equilibrium and the optimal trade entry area, and then trading higher above institutional order flow. How often does that happen? And when it happens, what's the probability of it actually playing out? So just so that there is some, just more purpose to the session. And so I think with that, we have framed the session quite nicely. Let's jump into it. Let's jump into it. So as you guys can see, we have, I've marked out the first point, which is, look, if we, Sunday 31st of March, but let's just do from Monday. And yeah, I'm just going to get right into it, marking out each week interval, and then we start with our plotting. Should have done that in the beginning. Keyshing. So I've done this one, even though it didn't get there, and even though it was a low high and then candlestick that closed below. Well, this one formed the high and sort of closed strongly low, but the fourth candle retraced fully. Just to have a reference of technically we didn't have four clean highs candlesticks that formed that high here, and so already that's an indication that we didn't get that strong pullback, or we weren't going to get that strong pullback. We did come lower, but not to the 50% level, but not all the criteria was met. And I just wanted to have at least one screenshot that clearly showed what not to look for in a sense. And so similarly with this, uh, strong pullback. And some of these, you'll see that um, even though it did, like you see this one, it formed a high, look strong, close lower, and then did tap into that equilibrium and then slightly below into the discounted area, and then traded higher up back above equal highs. We did get that, but it wasn't clear in terms of showing us four candlesticks, probably because it was an hourly setup. Some sort of lower time frame setup. Similar concept, but couldn't identify it on this time frame just because it wasn't yeah, that ideal time frame for the setup. So there's also that. So, and note it can either be the start of the swing point of this parent swing, because you can see this is one price swing higher, but within it there are multiple impulses, corrections. And so we can either use that point of origination and then take it to each subsequent high, where I think it's probably less likely you're going to get that deep pullback until it's the extreme high of that parent swing, if you want to call it that. But within that, you also then have obviously the impulses that form as price is trading higher. So just identifying where price forms a low time frame pullback and then swings higher will then also give you uh, that lower time frame move. So it works on both the larger swings, both from the main start point of the impulse to each subsequent high, but then also the start of the impulsive swings within the lower time frame impulses to the high time frame swing highs. Um, so yeah. And so I know I said after each week I'll give an update, but I think because it is the 4 hour, um, each month probably makes more sense. It also depends on how many screenshots I've taken. Um, and so I think just for, yeah, this 4 hours sake, each month is fine. Mhm. And I think with that, that's our last setup for the month, or at least swing higher. And so, yeah, this was the first one, obviously, that I went through. I explained it briefly. Occurred in the second week of the month. Um, and then, yeah, the following week, so week two, um, this was probably, well, there were two, I guess, entry opportunities. So you can see the blue circle where I've marked the impulse starts from. The impulse, we then form the high. And then this is where I kind of lose Michael a bit, where he says four candles, the fourth candle closes lower than the candle that forms the high, but he doesn't really specify whether you start counting from the candle that formed the high or from the candle before the candle that forms the high, because even in that high, obviously there's characteristics in it where you look for uh, high, lower high, higher high, and then lower low. So it's think of your market structure shift, your interbank price delivery model, where you have consolidation, run of the highs, expansion, and then reversal, which obviously signals that there's a shift of structure coming. But you're looking at that from the lens of just candlesticks. So with this, you can see there was this candle here. You can see we formed a clear high with the wick, and then we had the next candle which ran the highs. And then I marked this candle here with the highlighter because that's the candle that um, obviously signaled that we have closed below the candle that formed the high. It was only the third candle though, if I started counting from the candle before the one that formed the high, and then obviously the fourth one retraced slightly. But even that candle that closed below this candle that formed the high, that already tapped into equilibrium. And you can see on the left here, we had an order block. So probably a low time frame setup. You can see there was a high, a low, a swing high, and then obviously that retracement lower. It looked like a pretty deep retracement though. So it might have been 79%, potentially beyond, but that could have been a trade setup. Price traded higher. We didn't really get to the equal highs, but that's fine in the context of the 4 hour. That wasn't where we almost formed the extreme pullback, because we did come lower, tapped into that 62% level, and then that was obviously the low of this. And again, we're not. I'm not going to be specific on how we enter. This is, remember, just framing conditions where buyers come into the market. And so we come lower into that area. And whenever I identify the lowest point of the pullback, I also look to the left and see what was there that price could have reversed from. In multiple cases here, I think this one and the one below, we had an order block. And so trade into that order block, respected first time, second time, and then third time as well. And then price shoots higher. Old institutional order flow, maybe on a 1 hour, these were clean highs. And then we tapped above that, and that would have been our take profit. And so this was a pretty clean example. And then running to the next one, we have this point where price formed the low, and then start of our impulse. At the start of the impulse, I just marked this order block. Again, no points in price where the market, where there was a quick movement from, or where the market had a quick movement from our previous lesson. That would be an order block. And so we had the impulse, form the high, start counting our candlesticks. You see, this one's different. It's 1, 2, 3, 4. The fourth candle from, if we started counting at the candle that formed the high, closed. Well, technically this one did. Yeah, so maybe I'm actually wrong there. I should have highlighted this previous one. It depends. I start counting, because if it was 1 for this high, below a high, higher high, 2, 3, 4, this fourth one's already closed below. Already on the fourth one, we were at equilibrium. And then, from this one that's highlighted, we had already started to come lower. So let me just actually replace that, because it's kind of annoying me. Okay. Okay. 1, 2, 3, 4, close below the candle that formed the high at the at equilibrium, and then we come down into our discounted area. We come right down into that optimal trade entry, 70.5 level. That's our extreme low. We also then tapped into that order block. and then we traded higher from there. And I'm mistaken. There was one more setup because we can see this was an impulse in its own right, and then we had the correction, and then both this lower time frame setup as well as the one we identified in our main price swing both failed to reach their respective highs. And so, yeah, that's an area where while it didn't reach TP, what I'm also asking myself is if I did get into the setup, where could I have gotten out the position, given that we were in profit technically, and this is a 4 hour uh, chart. So that's a lot of pips that you could have caught. And so obviously would have been managing it, would have walked away with something. Obviously, getting out at these equal highs here would have been first prize, but the market doesn't always go to that extreme point. And so you can see we traded higher from this lower high, higher high, and then we shifted aggressively. So that could have been the first sign, and then maybe coming back up into this level here. Um, could have been an opportunity to exit. I doubt it would have pulled back all this way without taking out stops. And so, yeah, that's just something to take note of. So, yeah, I think you guys are maybe starting to get an idea of what I'm looking for. The next lesson is equilibrium versus premium. And so at this stage, I'm not looking at any selling opportunities, which you can see we now shift sentiment and we start to come lower for quite an extended period of time. And I'm just going to move these over here because I'm not going to use them for a while. But you can see the conditions in the market change and we start to come lower from this point. I think for pretty much the whole of May, we're bearish. Is there potentially something there though? In the lower time frame, potentially here. You can see it's a correction, but it comes down to equilibrium, wicks into that optimal trade sort of entry range, comes back higher. This could have been a trade. Look, this is Monday essentially. Yeah, you could have caught one trade because whole of Tuesday, well, check Tuesday, yeah, whole of Tuesday and basically Wednesday, we were bullish. So those are buying opportunities there. But yeah, lower time frame trade. If we just count the candlesticks and something, I'll probably pick up and when I do the 1 hour, but nothing for now. And then yeah, we then from mid-May or like third quarter of May start to trade higher again, so we can start looking for opportunities once more. See, aggressive swing high. Um, what I just also want to take note of is that run of liquidity before we then shifted. As you guys can see, clean highs that we eventually run. And okay, so that's the end of May now. Cool. So I think we only had, yeah, two. Yeah, because that was April and then this was May. So yeah, throughout this bullish cycle in May, two clear impulses. Um, was you had this impulse, correction, impulse. I think this one runs into June, but clear structure. I think over the course of May, I like that at this low we ran this liquidity first, and then started displacing higher. Um, so pushed up. I noted this as the candle that I started counting from, just because it was the last bullish candle. Even though this did form the high, this was the candle that I said look close below the candle that formed the high, or rather the last bullish candle. But if I wanted to be maybe technical, I would have taken this candle here. But in any case, we did start to get that correction lower, very clean correction, equilibrium, almost into that optimal trade entry area. Noted the bullish breaker block that we had, and price reversed, I think, confluently from that area as potentially an order block on a lower time frame. But yeah, we started pushing higher from that equilibrium, and then targeting old highs. Yeah, very clean move higher. Um, and so that was the first entry opportunity. And I'm sure there were multiple. Obviously, if we would be taking it on a lower time frame, so there would be multiple in that. And then similarly with the next correction, price traded higher, clean high, one, two, three, four. The fourth one retraced fully, so counted it on the fifth one because that one did close below this candlestick here. And then we got that pullback right into that 62% level. Confluent two-sided fair value gap, as well as a lining up with that breakout area. So that technically then becomes a break in structure gap, because that gap formed as we broke that previous high. And then I just didn't do that. And so clean push higher from this level, and then targeted that old highs that haven't been tested in a while. Um, yeah, literally to the T, collected those orders above there and then started selling off. And I sense we're probably heading into another bearish cycle. We are. So yeah, I think just because it is the 4-hour time frame, we've been able to get through this in about an hour. Got some comments from Varad. I'm good, bro. How are you doing? How are you doing? Thanks for joining the session. And so, yeah, let's just jump into the next phase. candlesticks. Yeah, I think that's the last one that I'll probably do today because well, there is this one that's currently forming, but that's 100% retracement, deep discount, but it's also still forming. We'll see. It could push higher from here or trade lower. So, yeah, we'd potentially be forecasting, but I think given how we consolidated here, ran lower, with momentum, um, good chance we may potentially push higher from here. We've still got this order block that hasn't been violated just yet. And so, but I mean, sentiment on the rand is still fairly bullish. Got US elections coming up. Um, so let's see. I think from a daily perspective, yeah, we are in a fairly deeply discounted area. Just looking at this main price swing, let's just see where we are from a daily perspective. We can forecast this a bit. Yeah, clean has some room to come lower, but we are in that optimal trade entry area. Um, and so, yeah, I think just coming back to this, we had again two setups in no, yeah, three setups in June. This was the first one. First setup, fairly clean. Disregarded this just because not enough candlesticks for it to be valid. Probably on the hourly, there was something clean there, and if you eyeball it, it was around 50%, but could have just missed it as well. But I think just because it didn't really meet the criteria, I left it out. This one did. Four candlesticks. Last one closed lower than the high. Came down right into that equilibrium level, confluent two-sided fair value gap at that area, and then we traded higher up to those equal highs on the 4 hours. So clean there. The second one, this would have technically resulted in a loss from this impulse. Yeah, traded higher with one, two. It was a third candle, but look, it would have been this one, but technically it still did close below the candle that formed the high, so still valid. Came down into the 79% area, confluent order block, and two-sided fair value gap that was respected. But then we obviously gapped down, and that wouldn't have played out. But it had all the criteria. Uh, and so But fortunately, in the same move, even though we took a loss there, um, I think in the past, even though this shifted this 4 hour structure here, we were still trading within this larger sort of parent swing. If I took it from the first point that formed the impulsive swing after that long bearish cycle. And so when I extended the fib down to that level, we were actually at the 79% level. We had that order block down below, and we got the sweep of liquidity in that area. Then price traded up really nicely from that area. Um, again, up above old institutional order flow. And so, yeah, and then a trade that I really would have seen as bearish before, after this impulsive move here, and then we obviously closed below this 4-hour structural low, and I would have been looking for longs in this area. Is now a trade that I can see was actually just in deeply discounted buy areas. And when we get something like this, where, as you can see on this one, it was valid, but we still violated it lower. But if we zoom out, we still are trading in those deeply discounted areas. These are almost characterized as stop hunts for all these stop orders that are lying below these high time frame lows. But we eventually do obviously respect the discounted area and then come higher after that, unless we didn't obviously and traded below here, which we might be getting at this point, because then on a daily level, you could see we are in that discounted area. There is room to trade lower, but we could be coming to collect orders below this low here. And so, how do we know whether price is hunting stops or really shifting character? Yeah, Michael says understanding, equilibrium and building this framework is a step towards that, because we could see here, clear example on this trade, we did come lower and we violated these lows. Could have been shifting structure, but then if we take into consideration what the daily was doing and seeing that we are actually more trade entry on the daily, that's an indication that might be a stop hunt instead of price actually shifting structure. And so I think it's combining the various high time frames to form the clearest picture. You'll never know exactly what's going to happen, just because at the end of the day, it is all about probabilities. But yeah, I think from the session, it's clear to me that this is a concept that works, and one that is going to go a long way to at least framing when buying conditions are optimal. And then once I obviously get into the equilibrium versus premium, we'll be able to frame selling conditions as well. And then coupled with obviously lower time frame entries and all of that, definitely result in improving my edge, getting this challenge. So yeah, that is quarter two back tested on USDZAR 4-hour time frame. Next week it may be equilibrium versus premium, or I may do a combination of both. It'll be like a fair market valuation sort of session where I'm not only looking at buys or only sells, but looking at how we can combine those two concepts of discount and premium, to then, I think, flow better with the market. But yeah, shout out for those who join the session and those who will watch afterwards. I hope there's value you took away from it. I personally enjoyed the session a bit more. I think the whole thing of backtesting more and talking less worked well. And if it felt a bit boring, then I think pull up the chart and backtest with me, because then at least I think you'll get a lot more value out of it that way. And then we can kind of backtest together, and then after each month, obviously brief, and then we can see if we're seeing the same things. If there's something you're seeing that's different, then yeah, you can comment and we can discuss. So remember, guys, consistency is the choice you make when you start doing the things you know you should be doing day in and day out.